things about the stock market is that every time one person buys, another sells, and both think they are the cleverest people in town. With that thought, let me welcome you to our Zoom web series hosted by One Tree Hill and PMS Card on the Juggernauts, where we are having conversations with uncommon and curious fund managers. Hi everyone, my name is Jai, and I have today with me Shrey Loonker, who is the fund manager at the Motilal Oswal PMS. Welcome Shrey to our show.
Thank you. Thank you, Jay, for having me over.
Excellent. One of the things that we like to, dive into is what we call the machine gun 15. Just to get our creative juices flowing, hopefully help a bit loosen up and exercise if you're already not. And, what I tell everyone is hopefully it's as much fun as it is for us on this side.
Yeah, no, I'm sure. I'm looking forward to it.
Excellent. Excellent. So if you're ready, I can start off.
Yes, please go ahead.
Perfect. Will India see a ratings downgrade?
No, we shouldn't.
Okay. Why do you think the markets are going up, notwithstanding SGX Nifty today or yesterday?
Generally, in the last 5 years, the only lesson that we've learned is respect liquidity more than fundamentals. Okay. And I guess the answer remains more now.
So is there might be a liquidity push on the sell side that you foresee as well?
Yeah, I mean, it will be a tug of war. That's what volatility is all about. Volatility is never one way. It's always up and down. So I guess the journey will be made interesting thanks to the liquidity and the short-term nature of this liquidity. So
fair enough.
So to that extent, I guess the bumpy rides is interesting because at every downtick, markets get more and more sanitized in a way. And as you know about sanitization, the more sanitized you get, eventually you get to a core which is very strong eventually.
Fair enough. Very interesting way to look at it. Talking about liquidity and liquidity of a different manner, will oil go back below zero in any future contract?
Well, I hope not, actually. See, extremes of, as we, as our grandparents used to say, excess of anything is bad. I think same holds true for everything, even crude.
Okay, fair enough. You don't say excess is bad if you're referring to your grandparents?
No, I mean, it's sometimes when you realize when you're in a lockdown mode, you get more philosophical and you start relating with things in your past.
Right.
And I think this time I think it's more of that. That I think the excess of anything on any side is bad. So as long as things remain in a tolerant band, I think it's much more beneficial than being in an extreme band.
Okay, fair enough. How long do you think India will remain an emerging market?
Well, wow. So this is a question to Mr. Modi. But to be honest, I think in the next 5 years, I'm hoping that we'll be able to shed that tag off our back.
And the dream of a $5 trillion economy, is that put on hold, or is that still something to chase after?
No, it's absolutely there to chase after. The only thing is, the timelines do get elongated because of this.
Okay, fair enough. One of the biggest red flags that maybe you see in a stock when picking a stock, except for corporate governance?
The biggest red flag has always been that many times for extended period of time, equity valuations stems from FCF, which is free cash flow.
Sure.
But many a times, there is enough ways to figure out the disconnect between OCF and the P&L statement. I think if we can keep creating that bridge and operate above OCF a lot more finer, many times that results into things which typically gets missed by a naked eye.
Okay, fair enough. Which balance sheet do you think is the most stressed? The government, the corporate, or the individual?
No, so I don't think so. There's one answer to that, but clearly in any distressful times like now, be it the World War II, be it the World War I, this is no different than a world war in many sorts. Eventually, the government balance sheet will be the most stressed.
Okay. Would you do a top-down or a bottom-up approach?
Absolutely bottom-up. Not just now, but forever.
Okay. I think this is This is probably one of our last interviews, and we are at an even match between fund managers and other investors saying top down or bottom up. So it literally comes down to, I think, what sort of resonates with you.
Yeah, absolutely. Absolutely. A
Perfect.
bottom up is a lot more clearer because there are lesser variables you deal with when you analyze a company bottom up. But the
Sure.
moment you think top down, you tend to become more of an economist with and the multifactorial model becomes even more complex and multifactorial,
Fair
uh,
enough. Fair
which
enough.
complicates things.
Okay. Okay. What percent of the times are you right in the markets?
I hope to be right 52%, 55% of the time.
Okay, perfect. And thus, in terms of percentage, but hopefully the times you're right is obviously much more higher in
Exactly.
content.
Exactly.
Okay.
The magnitude of your rightness is much more than your
At,
fallacy.
got it. Got it. One aspect, Shrey, which very few people know about you.
Uh, I'm incredibly consistent in my narrative.
Okay. What is one thing that, investors across decades have always got wrong in the markets, or maybe a misconception that investors have about the markets?
No, I think it's, see, many times when you look at investors, which are typically fund managers, but many times we miss the fact that we are as much an extension of as much of a behavior as a client projects. So many times there are things that we want to do, but because of the flows, we are not able to do what we want to do many a times.
Sure.
And that's where a PMS structure kind of scores well, because the moment you start operating like on a model portfolio, you start thinking dispassionately
Right.
and de-linked with the marginal flow who will determine what you will do next for every investor who's been in your fund so far.
Sure.
So to that extent, a model portfolio approach is a lot better way. It's more closer to blue-blooded investing
Sure.
uh, than Uh,
Okay. 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 Would you double down or double up?
um, no, so I mean clearly, I'm a big fan of dollar cost averaging. So
Okay.
um, I think I will always double up when the stock goes down 20%. Uh, and many times I tend to make it mechanical. Once my understanding on a company is clear, once my vision on the company is clear, every
Sure.
time it goes down more than 20%, I will have to commit more.
Okay. Okay. Fair enough. And would you consider yourself an optimist, pessimist, or a realist?
Oh, I think every investor will be an optimist. Yeah,
Okay. So, in a sense, do you need to be an optimist to invest in the market?
absolutely, absolutely.
Okay. Perfect.
You need an optimist to withstand the volatility. Let me put it this way.
Okay. Okay. Fair enough. Till when do you see? Everyone is talking right now of credit contraction. But when do you think when do you think we'll end up seeing some amount of credit expansion kicking into the sort of the economy?
So the credit expansion comes in two forms. One is the corporates, so three forms actually: government, corporates, and individuals. The government is happening as we speak, but banks are not the big lenders. Banks are lending incrementally a lot more to the government, but there are other sources of finance for the government. So
Sure.
uh, when you come to credit by itself, then you're talking about corporates and individuals. When you talk about corporates, corporates will come back much faster than the retail will come back, in my view,
Okay.
because in retail the risk aversion could last a little longer than the corporates. Because in corporates, what will happen is, because of this stressful times that lies ahead, the weak will get separated by the strong, and the strong will keep getting stronger, and it's always easier to lend to a stronger balance sheet.
In this entire market, everyone is talking about identifying the next theme, right? Which will sort of break the market and lead the rally whenever it does occur. Where do you see the next innovation taking place? Not necessarily to our equity markets per se, but overall.
No, I think so. One thing you rightly said, Jay, is in distressful times like now, typically the best innovations come now, right?
Huh,
But I mean, this conversation we are having, this itself is an innovation which was unheard of 6 months ago.
absolutely.
But now it's there. It's part of our life. Uh, uh, so the so innovations will happen. uh, you are the other way to think about it is what will alter trends, or what will be that which will accelerate a particular trend.
Sure.
I think the couple of trends which will accelerate is a lot more into wellness and fitness, which includes insurance as an ancillary theme to that.
Okay.
I think that's where we will alter. It will alter our minds. It will alter our outlook towards it.
Okay. Fair enough. The last question, probably the most difficult question. Are we at the bottom of the market, or is it even possible to time the markets?
No, absolutely. There is no way you can time the market. Timing the market is, uh, you know, it's more luck than anything else. So it's like I often say this: timing the market is like playing teen patti or playing poker. Or not poker, playing teen patti with a blind hand. And you win, you feel great, but somewhere there was luck in it.
Fair enough. That's a great way to explain it.
Yeah.
Perfect. Shrey, this has been great. I'm happy to say you've come up with flying colors, and hopefully, your coffee with Karan Hamper should reach you at your house as soon as this lockdown ends.
Okay,
And
great.
talking of the lockdown, where do we've seen an extension of around 15 days, segregation into zones, etc. Where do you personally see the lockdown going forward?
No, see, the lockdown was very synchronous, but the opening of the lockdown will be a lot of asynchronicity will be there, because each cluster is behaving very differently from the other cluster. And unfortunately, India, although it's divided in states, but in essentially it is very borderless in many ways.
Sure.
So to that extent, the mobility of people can again create trouble. And that's why I think this cluster-wise reopening, it'll be more calibrated. It'll be much slower. I think mentally we should be prepared that it's life will take a while to get normal.
Okay.
The only caveat that I would like to plug in there is if tomorrow we get a cure, or a vaccine is still some time away, but if we get a cure, then probably people will start becoming a little bit more bolder
Sure.
to go back to normalcy much faster.
Okay, fair enough. And now focusing a bit on the Motilal Oswal PMS, and I know you guys have sort of weathered the storm relatively better than most. Obviously, counts towards your experience. But if you could just elaborate what sort of what the edge is, whether it's the fund manager, the team, the processes, the USP, etc. That would be really helpful for our audience.
So it's a sum of all those things that you mentioned, Jay. No one thing can offset the other. Unfortunately, each one of them has a role to play.
Sure.
And essentially, what matters in not just in these times, in every time, is you got to be know you. The first thing is you got to know who you are, and you got to know what works for you, because what works for me need not work for someone else. Even
Sure.
though we both of us could be right, but essentially what you should be doing is what works for you. And you should only invest money what you understand. Many times peer pressure and consensus building and the narrative buying, these kind of biases draw you in. But if inherently you have to be very honest with your own self before you be honest with your client, that if you really think this is a company where you are willing to trust your money as a stakeholder, not a shareholder, because the moment you start thinking of investing in a company as a shareholder, uh, you start thinking more short-termish. The moment you start thinking about a company as a stakeholder, you really tend to push yourself to ask yourself a question: Will I be? Do I want to partner with this company for the next 5 years and 10 years? So it's actually something like a marriage in a way, where you actually don't. It's not about just a one-night stand. It's actually a much more longer-term relationship, and you do that much more diligence. But once you commit to it, you stand by it and stay with it.
Okay, okay, fair enough. And we also mentioned about processes, etc. Uh, Sometimes what does happen is, we get married to a particular stock, and sometimes, as they say, we have these blinders. How do you prevent something from, how do you prevent someone getting married to either a product or a stock? Like, what are the questions that should be asked continuously to oneself to prevent one from doing this?
No, that's a great question, Jay. So generally, these are biases, right? Which comes and which is very normal for anyone to experience it. The only thing that I do is whenever I freeze my view before buying the company, I try and pen it down to the utmost honest way of looking at things with a very clear, objective, numerical glide path to it in terms of the projections or in terms of the price targets that I have. And then once you have it documented, your original line of thought, then you keep mark to marking, not the stock price, you keep mark to marking your own thought process against it. I think
Interesting.
that's what makes it a little bit more objective than just assessing stock performance. Uh, and it pushes you to really understand what works in the long run and what doesn't.
Okay, that's one of the most unique ways where you're talking about mark to market your thoughts rather than the price, and
Yeah,
hopefully those converge at some point.
absolutely. It always converges. If your thought process is right,
Sure,
it will always converge, even though late, but it will always converge.
fair enough. And talking about your thought process per se. When was the first time sort of it was your interaction with the stock market? Was it by accident? Was it your sort of family was already in the stock market? You would love to know more of how you entered our world of the market.
No, no, my family was far away from stock market. I'm born into a family of CAs,
Okay,
and as a
not
CA,
so far away then, maybe.
yeah. So as a CA, the dharam was either do audit or tax.
Okay,
I tried my hands both
okay,
at both, and then I realized that this is not my cup of tea, and I didn't have money.
sure,
And because I didn't have money, the only option was go to equity markets, because I wanted to honestly be an entrepreneur,
sure.
but because of lack of capital, I couldn't. So the next best thing that I could do as a secondary goal to my entrepreneurship goal was to invest in businesses uh, who have the courage and the capital to start a business and be a stakeholder rather than a
Okay, okay.
entrepreneur themselves.
Well, no, clearly you've done well for yourself, Shrey. And sort of, on that, sort of again saying that, participate in good businesses, right? Has there been time that while you have set up a process to identify a good business, do you need to continuously sort of adjust, revisit, relook at different ideas that you have and saying that, look, I might go wrong out here because the world is changing much faster, or anything for any other matter where you need to keep readjusting your sort of outlook, or how often is it becoming more and more fast paced?
No, so it's a great question, and yes, things do change. Things have changed a lot. Cycles have become shorter. Cycles have become deeper. Volatility has increased. So these kind of things obviously do test your complexities, and the environment has also become a lot more complex because the customers have become that much discerning, that much disloyal. So the
Sure.
adoption of new trends is a lot faster now than probably 15 years ago, and
Right.
that's why you have to be very mindful, very open-minded about the new trends emerging in your portfolio companies from a competition standpoint, and how that needs to be kind of altered and rewired into your new thought process. And what helps in these times is, so as a matter of practice, what I do is I generally have very little interaction with the brokerage houses, because I mean, I like to do things a lot more myself.
Sure.
But whenever I have a particular analyst who has an opposite view on my stock, that really excites me, because
Okay.
maybe I will learn. Maybe it'll be a good mark to marking of thoughts.
Sure.
Uh,
Sure.
uh, you know, rather than someone who's confirming the same views that I have.
Sure. No, very interesting. Uh, what, whenever I talk to my clients, a few of my clients tell me that, Jai, we're probably not hiring you because, you have a magic wand. Nobody does. And most people realize that. And we're probably hiring you because we are guessing you've made enough mistakes in your past, right,
Exactly.
to not repeat them for us,
Yeah.
right?
Yeah.
Has there been one or two mistakes, that where you've paid a significant amount of what I call a tuition fee, and saying that, look, this has been one of the two great mistakes that I've made, and hence a sort of a pivot in my life where I've learned a lot from.
No, mistakes are plenty, and that's what makes you wiser. It's like a bottle of wine, right? The more age you gain, the more moss you gather, the more fine you become. And I think clearly there have been many mistakes, but the striking mistakes in the last 3-4 years have been the ones where uh, I ignored. So we always, when you look at a company, you tend to look at the concentration of clients, you look at the concentration of profitable products or whatever, right? You look at the concentration risk on the P&L, but very rarely you look at the concentration risk on the gross block. And that's why in one of the companies where so when I inherited the fund, it was already a portfolio company, and it had a very significant concentration of particular factory, which was the fulcrum of the cash flow, and it was a regulated business.
Sure.
And if that concentration risk triggers, it actually takes a balance sheet down. So I used to apply, and before that, the concentration element a lot more from a risk mitigation perspective to the P&L. I think that taught me how it applies equally to a balance sheet as well.
Okay.
The second mistake was more of, the when the tailwind in the sector and the opportunity or the addressable universe or the profit pool is so large, you tend to get enamored by that, and you start ignoring the small mistakes that the promoters are making. And when many small mistakes a promoters make, you keep ignoring it. But when there are many small mistakes a promoter makes, it becomes one big problem eventually.
Okay.
uh, so because the promoter was making small mistakes, you tend to be a lot more long-sighted, far-sighted, and you say कि okay fine, गलती हो गई, ठीक है, he'll get better. Then
Correct.
again गलती हो गई, he'll get better. And before you realize, he's made so many small mistakes that you have a fractured balance sheet at your hand.
Sure. It's like the story of the frog in the hot water, where you keep increasing or warming the water, and by the time the frog realizes it's boiling, it's already too late.
Exactly. Exactly.
Fair enough. Fair enough.
Yeah.
On taking this on the opposite side, and I'm sure there are numerous examples that you would have, but maybe if you can point out one really strong example, which was very obvious to you in terms of what really worked, but the market sort of missed it, and you were able to make a lot of money out of.
So I think probably there are two things which strikes out in my mind. One is the allocation on pharma that we did 2 years ago. We took a very bold call on our portfolio on pharma, but that stemmed from 2-3 reasons. The narrative was very negative, and the narrative was right for that point of time. But the moment you take a 5-year outlook, you realize that uh, eh, all those negatives are transitional in many ways, because many people had concerns about US doing predatory pricing on the generic prices, and as a result the profitability of the Indian pharma companies coming into serious pressure. But beyond the point, that cannot continue, right? I mean,
Hmm.
if 100 has come down to 50, doesn't mean 50 will go down to zero. uh,
Sure.
I think the narrative had become almost like that. And at that point of time, we realized that if pharma companies don't make money, fundamentally, the science will stop advancing, because they will stop investing in R&D. So, at any point of time, the government themselves will realize that they need to strike a balance between, let them have profitable growth so that there is advancement of science, so that issues like COVID can be handled much better, right?
Sure. Sure.
Uh, I guess at that point of time, we realized that pharma companies had capacities which was huge and underutilized. So the capex cycle was over. The narrative on the P&L was very bad and continued to be bad until just about a couple of months ago. We held on to the calls for 2 years. It didn't do much for us, but I think in the last 6 months, uh, it's probably one of the best allocations that I would
Right.
have done. But so the point being that for 2 years, when something didn't happen, you need to be so sure. You keep marking your thoughts, and
Right.
you start seeing incremental evidences which strengthens your thought or weakens your thought, and you have to be very honest in admitting that. And
Correct.
the moment you're honest in admitting that, so in the last 2 years, my allocation on pharma has only gone up.
Wow. Okay.
So that's the kind of learning curve that it took. And the second one was that people, in insurance, people start looking at insurance as part of BFSI because the nomenclature globally is BFSI.
Right.
But people fundamentally miss the point that insurance in India is not as interest rate sensitive as it is globally.
Sure.
So when in US, BFS and I comes along with it, it makes really a good sense because the cycles are very similar. Interest rate cycles affect both the businesses and both the balance sheets in a similar magnitude. But
Sure.
in India, the balance sheets are has so less risk that the interest rate sensitivity is so less that to
Right.
count it as a cyclical along with a bank
Right.
is actually wrong. In fact, I will go to the extent of saying that it is actually a counter cyclical to a
Sure.
bank. So, and
Interesting.
spinning that whole way of looking at, and context, getting the context right. That what is the context of global insurance companies and what is the context of Indian insurance companies? That really helped a lot. And that is again one of the very significant allocations and have been for the last 2 years.
Excellent. Excellent. That we've seen a significant shift among the more sort of the nuanced investors from mutual funds to PMSs and other alternates as well. Now, while it has not played out, and there's been talk that PMSs are more concentration, etc. PMSs sort of and EFs have been pushed a good degree in our industry by advisors, distributors for various reasons. One of the things that obviously comes up as well is that a lot of people are perceiving mutual funds also to be sort of some sort of closet index funds, right? Or index huggers. Would you sort of agree with this? I know there's a good chance you might be biased, but you have to ask for an unbiased view, at least for the nuanced investors. Is this something that you guys are also seeing?
No, so I guess, Jay, I think the answer lies in the data, right? And many times it's not about opinions; it's about what data talks.
Sure.
And if you look at the data, I think most of the mutual funds will be 60-70% index cloned, so to say.
Right.
And uh, and uh, and and that is the reason why, in a way, you're not too wrong that they are index huggers. But there is 20-30% in most of the schemes where they take active risk. The only difference that the way I look at it is over the next, say, 20 years, um, the asset management industry will pivot towards, there will be a base of passive investing. On top of it, there'll be a small layer of algo smart beta investing,
Sure.
and then on top of it, those guys who are pure absolute return generators. And that will make a good fulcrum. So when anybody, when I was part of the mutual fund, I used to always wonder that why do I have to park 100 rupees with a mutual fund when I can do the same 70 rupees in an index and just give 30 rupees to the mutual fund.
Sure. Sure.
I think eventually the texturization can look more like that, where you look at more the second is, I think in a PMS, the concentrated style of investing really works well, because one thing we need to understand and respect is every human has its limitation on its bandwidth.
Sure.
A human brain can probably fathom 50 businesses or 40 businesses with utmost depth that it requires to kind of commit your money to it. When you invest in 70, 80, 90, 100 stocks in a portfolio, clearly you're stretching your own bandwidth, and as a result, the depth will get compromised sooner or later. That
Right.
is point number one. The point number two is, if you look at most of the global investors, the Pareto really works even in investing. It's your 20% of your stocks which will make you 80% of your money. And the whole idea is, where your conviction is high, it's very important to size your bets right. And to size your bets right, you need to have that wherewithal of working with a smaller, less is more then.
Right.
suddenly you start valuing less is more.
Sure. Sure. So concentration in equities is definitely sort of a source of alpha as well.
Absolutely. So long-term investing is all about that, right? I mean, you look at our founder, Ramdev Agarwal, even his 70-80% of his net worth will be in a handful of,
Sure.
places. And that is true for everyone. The Pareto is a global rule. It's a global principle, and it applies to businesses. It applies to individuals. It applies to portfolios as well.
Sure. Okay. That's again a very different answer than what we've heard till now. Shri, we're almost coming to the end of this. Just a couple more questions, and this is more
Sure.
related to the point that you had made at the very start. Is that you all follow a model portfolio, right?
Yeah.
But one of the thoughts which is emerging is that should fund managers be given the optionality of either trying to hedge using options to optimize returns, levered to an extent like what happens in an EIF, and specifically when the majority is a long only portfolio, right? Do you buy this view? Would you want that optionality at some point?
So I like to keep things as simple as I can, Jay.
Sure.
And in all of this, what matters to me is the more complexity that you create, eventually it will get more difficult for you to be optimally your best.
Okay.
Because so in that sense, I think um, for me, if I know that the long-term equity is a long-term asset, and a long-term asset over 10 years has never disappointed, then in the fifth year, on the sixth year, do I need to do something complex to make my short-term journey look better? When
Okay.
over a 10-year IRR, it really doesn't add up significantly more.
Sure.
Then why? It's about value and price, right? At the end of the day, the kind of bandwidth that you will put to make sure you're getting those hedging strategies right,
Sure.
and the kind of outcome eventually it will create on your portfolio, you would rather work hard on some other company and figure out where the value price is more, the gap is higher than.
Okay. 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 Clear. Very clear. Uh, the last question, and you had obviously a very interesting journey, Shrey. But for someone who's just recently started, maybe let's call it in, the last 2 quarters, right, where they've taken external money or managing client money taken from friends and family, and they've seen obviously a good amount of bleed on their portfolios, thinking concentration is great. What would you suggest to them that they do right now? What should they be focusing on?
No, so I think there is. I don't think so. It's about, see, we all are learning. Be it if I'm a part of a startup or I'm part of a big platform. We are still learning, and I think this process of learning just doesn't end. And I think Warren Buffett is the most, the biggest, or the Munger, Charlie Munger is one of the biggest example over there.
Sure.
So to that extent, it's not. I think the more important is people should really define themselves as to who they are.
Okay.
I think it's a process of more of a self discovery before you start marketing yourself. I think it's a process of more of your self discovery as to who you are. Try and articulate a philosophy or a caricature of your own belief system, so that and keep mucking it, so that you know that you're not getting cloned because of the environment, because the environment will change in such ways that
Right.
it will clone you uh, the moment you lose your awareness.
Shrey, thank you so much for your time. This has been a lot of fun. Hopefully, you had a great time.
No,
And
we did.
before
Thank you.
we wrap this up, is there something that you would like to add?
No, I guess somewhere you know uh, one need to understand that equity is a very forward-looking asset class, and when it's a forward-looking asset class, and in the world which is sloshed with liquidity, volatility will only increase. So it's only imperative for your clients to just fathom that fact, and try and gestate, because equity, if you're loyal to equities, equity is very, very rewarding. But you need to showcase your loyalty uh, in walking that talk. because one data point about value which is really exciting, and I always share it whenever I get a chance, is over we have a 17-year track record, which is about 6,000 trading days roughly. uh, if somebody invested 1 crore 20 years ago, they will be sitting on 21 crore rupees today if they stayed invested for the entire journey of 6,200 days.
Right.
The interesting part is, if you miss 10 days out of the 6,200 days,
Okay.
instead of 21 crores, you will make only about 10 crores.
Wow. Okay.
So
Sure.
and you don't know which are those 10 days. And that's where the loyalty matters.
Sure.
And the more important fact is, out of those 10 days, invariably 60-70% of those 10 days will come in a bear market.
Got it. Got it. No, thank you so much, Shrey. Here's wishing you and your team at MOSL, a great 2020. And please ask everybody to stay safe and stay healthy. Thank you again,
Thank
Shrey,
you.
so
Thank
much
you.
for your time.
Thanks.